Welcome to Breaking News to Trade Moves. Today we're focusing on a major market event, the IPO of medical supplies giant Medline. And for you, the learner who wants to quickly grasp what moves markets, our goal today is simple. We're going to examine what this listing signals about the capital markets, and crucially, which sectors are celebrating this and which might be facing some new pressure.
This is an important one because it's the largest U.S. listing we've seen in a while. It really reflects investor appetite for these big offerings. To understand it, I think we have to start with the facts of the offering itself.
Okay, let's get into the basic facts then. Medline priced an upsized IPO. It raised between $6.26 billion and $6.3 billion, which makes it the biggest IPO of 2025.
That kind of number definitely gets your attention. The stock is set to trade on Nasdaq, and the ticker is MDLN. It was priced at $29 per share, but here's the key thing to focus on. Where is that money going? Most of it, that $6.3 billion, is aimed at reducing the company's debt.
That's a crucial distinction. It's not all for, say, growth or R&D. It's for managing the debt that was built up while it was a private company. So what does a listing like this tell us about the broader market environment?
That really is the core question. It suggests investors are willing to fund these large, private equity-backed exits again. Even after some periods of, market uncertainty, this kind of successful listing becomes a barometer for market health and for valuations.
So the market seems open for business for these big PE-backed companies. Who are the immediate beneficiaries when a deal this large clears?
We've identified three main groups that are probably pretty happy right now. First up are what we call the capital markets toll collectors.
I like that term. These are the institutions that make the transaction happen.
Precisely. The size of this IPO generates some very substantial underwriting fees, higher trading volumes, and of course, listing revenue. A stronger pipeline of offerings just improves the general sentiment across that whole market infrastructure.
And we can see that benefit in specific companies. We're talking about Nasdaq, the exchange, ticker NDAQ, and Intercontinental Exchange, ICE, which runs the NYSE. Then you've got the banks.
Oh, absolutely. The lead underwriters, firms like Goldman Sachs, ticker GS, and Morgan Stanley, MS, they see immediate fee revenue. A deal this size is a major fee event for them.
Okay, so that's the first group. Who's the next category of winners?
That would be the alternative asset managers and private equity platforms themselves. Remember, Medline was a huge private equity investment. Its successful listing is a key proof point for their whole industry.
What do you mean by proof point? How does Medline's success help other PE firms?
Because it shows that large, profitable exits are viable again. It validates their investment models. That, in turn, helps their fee narratives. It proves they can distribute gains to their investors, and it builds confidence for future fundraising.
So it's about credibility for future capital raising. We should probably be looking at the big platforms here, like Blackstone, that's BX, Carlyle Group, CG, KKR, which is KKR, Apollo, APO, and Ares Management, ARES.
That's right. Their whole business model depends on proving they can execute these kinds of sales successfully. And the final category of winners is within Medline's own sector, the healthcare supplies and medtech volume ecosystem.
Medline is a massive distributor. They move everything. How does their IPO help the companies whose products they distribute?
Because a well-funded Medline, one that has managed its debt and raised public capital, reinforces strong demand signals across the entire medical supply chain. It suggests Medline is positioned to expand its reach and volume, and that's great news for its suppliers.
And strong demand for MDLN stock can also lift valuation comparisons for similar companies. So we're talking about players like Becton Dickinson and Company, ticker BDX, Stryker, STE, Medtronic, MDT, and Abbott Labs, ABT.
Yes. The market sees Medline's success as a positive sign for the stability of the entire underlying healthcare demand structure.
Okay, so for every winner, there's often someone else feeling some new pressure. Who's facing fresh challenges after this listing?
Let's start with the most direct group, Medline's competitors, the other medical distribution and supply chain rivals.
Right?
Think about it. A newly public, well-capitalized Medline has the resources now to invest much more aggressively. That could mean competitive pricing, logistics upgrades, a big push to capture new customers.
And that increased competition puts pressure on margins and growth for the other distributors. They have to spend more just to keep pace.
Exactly. So you look at companies like McKesson Corporation, that's MCK, Cardinal Health, CAH, Owens & Minor, OMI, and Henry Schein, HSIC. They now have a very ambitious, publicly validated competitor. Their job just got harder.
Okay, so direct rivals are first. What's the second category feeling the heat?
This one is really important to watch. Hospital operators who might be exposed to supply cost negotiation risk.
Ah, so this is about leverage in the supply chain.
It is. If distributors like Medline gain more leverage, either through scale or pricing power, then the hospital operators could feel that on their end. It could mean pressure on their operating costs, tougher contracting dynamics.
And hospital margins can be quite thin. Even a small change in supply costs can have a real impact on their profitability.
That's the risk. If Medline uses its new capital to lock in better terms, they might not pass all those savings on to the hospitals. It creates a headwind for operators like HCA Healthcare, ticker HCA, Tenet Healthcare, THC, and Universal Health Services, UHS.
They're facing a stronger counterparty at the negotiating table now.
Okay, that makes sense.
So finally, what's the third category facing pressure? You mentioned this isn't just about healthcare.
Correct. This is about market rotation. A successful IPO like this signals a broader change in investor mood, which can hurt a totally different class of assets.
You mean the defensive bond proxy equities?
Exactly. The overall market mood, when something like this happens, it tends to move investors toward risk-taking and growth assets. It's a risk-on mindset.
And when capital rotates towards growth stocks, it often rotates away from those defensive names, things like utilities, which people buy for stable yield.
Right. They act almost like a bond substitute. But when confidence is high, those steady, safer investments are just less appealing than assets with higher potential returns. This kind of rotation can affect established utilities like Duke Energy Corporation, ticker DUK, Southern Company, SO, and American Electric Power, AEP. They can lag the market when these big transactions are getting done.
So what we're really seeing here is a key market mechanism restarting the private equity exit. And that has specific consequences for those collecting fees, those competing directly, and even those whose costs might go up.
Understanding which companies are positioned to gain and which face new competitive dynamics is essential as you monitor the markets.
And as you think about what this all means, consider this. If the IPO window is really opening up again for these large private companies, which other sectors might see a rush of listings next? Which other industries could see similar pressures on their incumbents?
And now, a required statement. This analysis is based purely on the information available and is designed for informational purposes only. This is not financial advice, nor is it a recommendation to buy or sell any security. This is purely the opinion of the author.